Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Today is June 24th of 2021. Several headlines we're going to discuss. We're paying attention to it here at Blanke Schein Wealth Management, and it's important to your portfolio, so let's get right to it. Well, on this Thursday afternoon, as I record this, it was just announced from the White House that there is, in principle, a deal on the infrastructure bill. Ultimately, the House and the Senate we're about $1 trillion off on their respective proposals. And obviously there's such a thin margin of sort of voting that the two sides wouldn't actually see eye to eye and reconcile. That being said, President Biden came in to sort of broker a deal and use his political will and has announced that they have in principle a deal. Now, we've seen this before where headlines are one thing, but the reality is another, because they still have to go through all the minutia. But the reality is that, call it 4 or 5 trillion, there's going to be trillions of dollars spent. So what do we pay attention to and how do we portfolio position on a go-forward basis? For our clients here at Blanke Schein Wealth Management, well, clearly there's infrastructure, but don't be fooled, because if you look at the last sort of previous several administrations, they've been a lot of bills that have been passed and made into law, and a lot of money has been spent and literally evaporated into thin air in terms of quote-unquote shovel-ready projects that never materialized. There's some solar projects that just literally were big zeros and a few other things. So you got to be careful in terms of portfolio positioning and what Washington really has come out to, what they finalize on. Ultimately, we spent a lot of time following after a deal like this, following what the senators then go and reposition their personal portfolios in. We did that earlier in the year with Nancy Pelosi, and year to date, it's done quite well for our clients in terms of just following what they're spending, how they're investing, simply because it's public information. And they know better than we do in terms of inside information, not to say it's inside information, because it has to be disclosed when they make purchases, and there's little windows of opportunity for them to do so. But don't be fooled. There's $4 trillion of our taxpayer dollars that are going to be out there over the next 3, 6, 9, 12 months and years to come once this eventually becomes law. So portfolio positioning becomes very, very, very important on a go-forward basis. Obviously, infrastructure, the EV market, electric vehicle market, we'll find out where we go from here as it relates to that. But that's also a huge portion of this infrastructure bill on a go-forward basis. So a green ESG look is the proper way of thinking about it. Again, we have growth continuing to, from a portfolio standpoint, outperform value, but don't count value out just yet. Because why is that? Value are cash flow companies, dividend-paying companies, dividend growers, if you will. We like that space. We like that space tremendously, the energies, the financials. And obviously we're looking at the banks right now, simply because the last few days they've traded down, but the Federal Reserve just came out with passing the stress tests, and they actually passed all 23 financial institutions that were in this. And remember, this is post-2008 from the financial crisis and sort of the Frank Dodd legislation that says the banks have to, on an annual basis, go through a stress test. Well, they just passed, and they have given the green light to increase dividends on a go-forward basis. That's cash flow. For our clients love cash flow. We love cash flow here because it's also part of the spendable return. It also stays ahead of inflation, right? We have right now sort of tale of two economies, and you can actually look at what we just recently announced right now is the unemployment rates. We're watching the jobs opening, the JOLTS report. That's a 10.1 million jobs report for the United States right now. So there's 10 million jobs across the United States and about 7.5 million people unemployed. So is it geographic location? Is it people still holding out from stimulus checks and sort of getting more money staying home than actual getting paid? I don't know this. Angel Stadium here in California right now is at 100% capacity. We just opened up in California 9 days ago, but they can't find enough workers, and their concessions are way overrun. We have a client friend of ours that has sort of inside track in terms of what's happening there, and they are 800% above what they projected to be at right now. But the challenge is they can't have anybody come back to work. If you look at this right now, the states with the highest unemployment rates are Hawaii, New Mexico, California, Nevada, and Connecticut. And coincidentally, right now, those are all the states that are still sort of weaning off of the additional stimulus to help those that are in need. But like I said before, you've got 10 million jobs that are open in the United States right now. You have California that just reopened within less than 10 days. And you see all of these venues in serious need because the demand, people are getting out, right? The vaccine is out there and people are feeling safe again and healthy to go live life again on a go-forward basis. So you're seeing that supply and demand really stretched right now with the labor markets. So what's going to happen? Will we get down to full employment? Well, if you go back to the last few recessions, it's taken at least 5 years on both sides, from 2001, 2003, and then 2008 to 2015, to get to full employment again. And we were just there, at about a 3% unemployment rate across all segments of the U.S. economy and all sectors. And we haven't seen that since 50 years low on unemployment. It could take 5 years to get back there. And hear me out on this. You have a lot of displaced workers that really may or may not want to go back to the workforce. You also have productivity. So a lot of companies, I've said this before, in the middle of the pandemic, you're going to see this. We're seeing a wave of this right now at Blanke Schein Wealth Management, a lot of influx of retirees. Our clients are retiring that were sort of waiting the extra 1 or 2 years, should I do it? They're doing it right now. So we've had about 6 retirements just in the last month and a half coming in. They're existing clients, but they're pulling the retirement ripcord, and we're helping them through that with their HR team at their existing firm, and we're making certain that everything's taken care of properly in terms of their retirement nest egg. But the reason why that is because companies are now saying, hey, listen, we want to sort of get rid of some segment of our population in terms of the workforce, and see if we can do a lot more with less people on staff. Therefore, they're not going to go back out and hire and replace, let's say, a retired employee that's been with them for 20 or 30 years. They're going to ride it out and see what happens with regards to their existing workforce. That's happening all across the United States. And what else is happening is they're going to do CapEx spending, reinvest those dollars in the company to be more productive, more efficient across the spectrum. So that unemployment might stay stubbornly high, but that doesn't mean that the market and the economy can't do well. In fact, labor is the number one expense for small businesses and businesses across the United States. So don't be fooled. Companies will do more with less people, and reducing ultimately one of the largest expenses on their balance sheet, which then increases productivity or profit margin for them. And then that translates for shareholders in terms of a larger cash flow or EBITDA, therefore shareholder return or even expansion on a go-forward basis if they can do things properly. So we position our portfolios according to that. We're seeing that all across the United States today. So don't let the numbers fool you. There are a lot of jobs out there and a lot of displaced workers. It's going to take time, could take several years for that to work its way out. In the meantime, the economy is going to do well because the infrastructure spending and another trillions of dollars behind it, you wait and see. To support the market. The Federal Reserve's engaged and ready to help out if the economy takes a slip or a step back in the next year or two. And corporations or GDP, corporations are making money, and our GDP is going to be 7% this year, 4% next year, and by 2023, 2024, about moderating at about a 2% GDP. That's a lot of growth that we see projected on the horizon. So from an investment portfolio positioning standpoint, we see a lot of opportunities, and we're very encouraged from an economy standpoint and employment. It's going to take a while for those jobs to actually, or for those workers to actually get out there and get back to the workforce. But like I said before, some of these states, California, we just opened up 10 days ago. Nevada just opened up at the beginning of the month as well. And what I hear, the numbers that we're getting is tremendous. People are out and about. So you know what? That's our update for today. Thanks for watching. I appreciate it. Like and subscribe, share with friends and family, and take care and have a great day. And don't forget, we've got a basketball game tonight, and I am a Suns fan because I was born and raised in Phoenix, Arizona. So we'll see how it plays out. Take care, guys. Thanks.